Hello everyone and welcome back to the sessions on CFA level 1. We are continuing under the subject quantitative methods, the discussion on time value of money. In this class, we are going to discuss about concept of net present value, in short NPV. Now in the earlier classes, we have seen in the application of time value of money that if there are any cash flows that will be arising in future, you convert those future cash flows to their present values. You discount those future cash flows to their present values. Once you arrive at the present value, it could be either a present value of an inflow or a present value of an outflow, correct? What if you start a business where there will be series of inflows and outflows? Correct? There will be a series of inflows and outflows, and then you are supposed to convert all the cash inflows and outflows which are expected to arise in the future to their present value. That is the value at present with respect to all the future expected cash inflows and cash outflows. So you will be classifying the present value into two components: the total present value of all the expected future cash inflows, and then the total present value of all the future expected cash outflows. When you compute the present values, if there is any initial investment required, even that becomes the present value of outflow. That means it also becomes the component of present value of cash outflow because it is already given in the present terms. Now, when you find the difference between the total present value of inflow minus the total present value of outflow, what you get is the net present value. Now, there is a big misconception that people carry in their mind. If I ask them, what is net present value? They will say, sir, net present value is total PV of inflow minus total PV of outflow. That is how you determine the net present value. What is the meaning of net present value? That is where we have to focus on. So definitely we are going to learn two things. Number one, how to determine net present value, and secondly, how to understand the core concept of net present value. In fact, what is the real meaning of net present value? What are the implications of net present value? So let us understand one thing. For computation of present value of any future cash flow, we need a particular rate of return. In the earlier classes, we have talked about the rate of return as the required rate of return or expected rate of return, which is also called as cutoff rate or discounting rate. So what is that cutoff rate or discounting rate? Fact number one, that cutoff rate or discounting rate is basically an expected rate of return. It is a minimum rate of return. Without that, you are not interested in making investment. So we are assuming that you are an investor in this scenario and you have some rate of return that you have expected in your mind, say 10% per annum. So that 10% per annum becomes your cutoff rate. That becomes the discounting rate. Now, why we are making that as discounting rate? Because that is such a rate below which you are not willing to make investment. Now, the question is, from where do we get this 10% hint? If I have to make an expectation, why 10%? Why not 20%, 30%, 40%, any rate of return? Suppose I expect 40% rate of return and I get an offer which is giving me 18% return. I say no, why would I accept 18%? I want 40% return. I reject that offer. I get yet another nice offer, lucrative offer, offering me 21% rate of return. I say no, I want 40% rate of return. With a false expectation of 40% in my mind, what eventually will happen, I will not be able to invest my money anywhere and my money will simply remain idle. When money remains idle, it will not generate any returns at all. that is where your expected rate of return, your required rate of return cannot be a fancy rate. It has to be a realistic rate. Means it has to have a logical point of arising. So what I would say, there can be two different understanding based on this. One is your cost of capital and another is the opportunity cost of capital. So let us first understand that suppose the rate of return prevailing in the market around you is 10% per annum. If the rate of return prevailing in the market is 10% per annum, what does that mean? That you have enough opportunity to invest your money at 10%. So you would not compromise for any rate of return below 10%, correct? That 10% therefore becomes your minimum expected rate of return. That is the realistic rate of return. You should not think of any fancy rate of return as your required rate of return, because that will make you land up nowhere. So let us assume that your expected rate of return is 10%, which is a realistic rate. So if you are investing $1,000 now, after 1 year, how much money you would want? As a return, you would want $1,000 plus 10% return. That would be what? $1,100, correct? In that case, if I offer you one investment opportunity that you invest $1,000 today, and after 1 year, I will give you 12% return and your money will be given back with that returns. So if you add 12% to $1,000, what you get is $1,120. That means the offer that I am giving you is appearing to be a better offer compared to what expectation you had in your mind. As a result, you would obviously be inclined to invest into the offer that I am giving you, because that is giving you little more money compared to what you were expecting. When you get something more than what you expect, you will be inclined to make that investment. Let us do one thing. Let us write this in the form of a structured example. So please look into the screen and look into what I am putting forward. You have $1,000 with you. You wish to invest this for 1 year. Your required rate of return, which we are considering as a realistic rate of return, is 10% per annum. You expect to receive after 1 year how much money? $1,000 plus 10%, that will be $1,100. Now Nikhil sir gives you an exciting offer. You invest $1,000 with him, and after 1 year you get back $1,120. So if you compare, after 1 year, Nikhil sir will pay you $1,120 and you expected only $1,100. So surplus amount after 1 year will be $20. Let us try to determine the net present value of this investment proposal. If I look into what is the value that I am going to receive after 1 year, means I am behaving like an investor over here. Okay, I am playing your role over here. If I am an investor, as per this offer, I am going to receive $1,120 after 1 year. So what I'll do is, on my calculator, I take the input of 1,120 and this amount I'm going to receive after 1 year. So this is going to be my inflow. I want to find the present value of this inflow. Because my discounting rate is 10% per annum and the period of investment, the time horizon of investment is just 1 year, and I convert this 1,120 to its present value, I divide it by simply 1.1, that is 1 plus interest rate. 1 plus 10% is 1.1. So what we get is 1,018.18. That is the present value of the inflow. From this, if I subtract the present value of outflow, because if I want to earn this cash flow of $1,120 after 1 year, I must pay $1,000 right away. So I subtract the present value of outflow, and what I get is the surplus amount, that is $18.18. Now what is this surplus amount of $18.18 and why the surplus over here is appearing as $20? Look at one thing. This surplus amount written over here is basically the surplus amount that would arise after 1 year, and when I am computing the net present value, it is the surplus amount at present value. In fact, I would say if you pick your calculator and take $20 surplus which is arising after 1 year and you simply convert that into present value, you divide that by 1.1 and what you get is $18.18, which will be the present value of that surplus, which we are referring as NPV. So let us do one thing. Let us first write up this content and then I get into the meaning of NPV. Let us quickly first write up that example that I have just mentioned. So let us compute net present value of the above offer. Cash inflow promised by Nikhil sir is $1,120 after 1 year. So required rate of return is 10% per annum. So present value of cash inflow will be $1,120 divided by 1.10. That will be $1,018.18, and the present value of cash outflow is $1,000. So what you get is the net present value, that is $18.18. Present value of this surplus if you want to find, because the surplus originally what we computed was $20. If you convert that into present value, you actually get $18.18. That $18.18 is nothing but NPV. So we can conclude one very important thing, that what is the real meaning of NPV over here? We can say if surplus amount after 1 year was $20 and the present value of that surplus is $18.18, what does that mean? That NPV itself is a present value of a surplus. Which surplus? A surplus that you are going to earn over and above your expected rate of return. That is one brilliant line about the meaning of NPV. Let me put it forward over here on screen. NPV is the present value of that surplus which the investor can earn over and above the expected rate of return. Let us understand one point very clearly. Why is this surplus arising? First of all, don't forget that the expected rate of return in the mind of the investor was 10%, and this investment, as per this example, is offering a rate of return higher than that. That is why the resulting NPV is positive. So a positive NPV indicates that you are going to earn a rate of return higher than what you have considered as your required rate of return. It is giving you a better return. That is the indication of a positive NPV. The next obvious question is, can NPV be negative? Answer is yes, obviously NPV can be negative. So in this example, if the required rate of return for the investor is 10% and the investor is investing $1,000 now for 1 year, the minimum amount that the investor should expect to receive after 1 year will be $1,000 plus 10% return, that will be $1,100. What if I change the offer in this example and I say, you invest with me $1,000 today and I will give you back $1,080 after 1 year. So you have an expectation of receiving a cash inflow of $1,100 after 1 year. If I am offering anything less than that, the surplus will go negative, and if the surplus goes negative, the resulting NPV also goes negative. Let us try to understand that scenario as well. So I would now say, Nikhil sir gives you an alternative offer. You invest $1,000 and after 1 year you get back $1,080. So we would say after 1 year, Nikhil sir will pay you $1,080 and you expected only $1,100, but you are not even getting the money equivalent to what you expect, and therefore the surplus amount after 1 year goes to negative value, that is negative $20. So if you compute the NPV of this alternative offer, you take the future cash inflow and convert it into present value. That will be $1080 divided by 1 plus I. Now keep in mind one thing, no matter what is the change in the offer, the expected rate of return in your mind remains 10%. So your present value of cash inflow this time becomes $981.82, and the outflow what you have to pay from your pocket right now, that is the present value of cash outflow, and that is $1,000. When you compute NPV, it is going to be negative $18.18. Basically $18.18 is nothing but the present value of this $20. Because this $20 was with a minus sign, the NPV also results into a minus sign. You can verify this by this calculation. PV of surplus will be $-20 divided by 1.1, that will be negative amount of $18.18. Let us move ahead and write up the meaning of NPV, what we just concluded some time back. NPV is the present value of that surplus which the investor can earn over and above the expected rate of return. NPV is determined in the following manner. NPV equals to total PV of cash inflow minus total PV of cash outflow. Let us move ahead and now write something important with respect to NPV. Before we write, let me first explain some very important notions over here. See, you have understood the meaning of NPV. NPV is basically the present value of such a surplus which you are going to get over and above your expected rate of return. So the moment we have a positive NPV, we can conclude that whichever investment you are making is capable of providing you a rate of return higher than what you are considering as your required rate of return. So keep in mind one thing, your required rate of return, your expected rate of return, cutoff rate, discounting rate, all have same meaning. But if the investment is capable of generating a rate of return higher than these, then it will convert into a positive NPV. It will result into a positive NPV. Correct? A positive NPV indicates that you are going to earn more than what you expect. You are going to earn more than what you are putting forward as a required rate of return. That is the first and very important implication of NPV. So what happens if the NPV is a negative amount? If NPV is a negative amount, we would say that whichever investment you are making, it is not capable of generating that much return which you are expecting. Maybe we have seen in that earlier alternative offer given by Nikhil sir, that in that offer also investor was earning something, still the NPV resulted into a negative value. That doesn't mean that investor is incurring a loss. Investor is still earning something. Investor has invested $1,000 and the investor is going to get back $1,080. So you are going to get something more than what you have invested. You will earn some returns. But NPV went negative because the return what you are generating is lower than the rate of return that you have required. So simple point is, when we make investment into any business which we may identify as a project. So what do I mean when I say a project? It's basically a business line that you are thinking of starting. Once you start a business line, it will start giving you streams of cash inflows and cash outflows over its life. Then at one point the project will terminate, the business life will come to an end, or there may be a perpetual existence of a business where we can expect some perpetual cash flows. With the perpetual cash flows, we will deal with a little later stage. Right now, if I consider a finite life of a business or a finite life of a project, say 5 years, 10 years, 20 years, then one point of time that project will terminate. When it terminates, it will give you cash flows on termination as well. So there will be regular amount of cash inflows and cash outflows throughout the life of the project. At one point, the project will terminate and it will provide you the cash flow on termination, which sometimes may be positive, which sometimes may even be negative. Your objective is simple. You transform all these future cash inflows and outflows to their respective present values. You also consider how much is the initial investment you are making, and that also will be part of the present value of cash outflow. And finally, when you keep one side the total PV of cash inflow, another side total PV of cash outflow, and find the difference between the two, that is total PV of cash inflow minus total PV of cash outflow, you will be getting the resulting NPV. If that NPV is positive, it gives you a clear hint that the project is capable of generating a rate of return higher than what you are requiring. If the NPV is resulting into negative, it indicates that the project is capable of generating a rate of return lower than what you are requiring. What if what rate of return you require and project is capable of generating exactly same rate of return? Then the resulting NPV will be 0. So when the NPV is resulting into a 0 value, it doesn't mean that you are not earning anything. It means that you are not earning any surplus over and above the rate of return that you expected, but you are still earning that rate of return which you have expected. So let us do one thing. Let us write these important points over here. With respect to NPV, the following important points must be considered. If the project is capable of generating a rate of return higher than the required rate of return, then investing in such project is beneficial. It indicates a positive NPV. When NPV is positive, it indicates that the project is capable of generating a rate of return higher than the required rate of return. And when NPV is negative, it indicates that the project is capable of generating a rate of return which is lower than the required rate of return. Let us move ahead and write up the implications of NPV, which I have already explained to you. You just need to note it down. If NPV is positive, it indicates that the investor is earning more than expected. If NPV is negative, it indicates that the investor is earning less than expected. If NPV is 0, it indicates that the investor is earning exactly what is expected. If NPV is negative, the investment proposal should not be accepted because of rate of return of the project is less than the expected rate of return. If NPV is 0, the investor should accept the investment proposal because the investor still earns that rate of return which is expected by such investor. Let us move ahead, and now we talk about some important notes on discounting rate. Now, first of all, what exactly is discounting rate? Discounting rate is the rate of return that the investor is expecting. So you can call it as discounting rate or expected rate of return or even required rate of return. And the point is, it is not going to be any fancy rate. It has to be a realistic rate. So it is not an imaginary rate, correct? Because that way anyone can imagine anything. What should be the realistic basis of arriving at this discounting rate? Two important aspects. One is the rate of return what is prevailing in the market. See, what is prevailing in the market, that only you can expect, correct? For example, you are going to be a freshly qualified candidate and you have observed that the pay package for any fresh qualified candidate is say $12,000 a month. Then your expectation can be little here and there, but you cannot expect that you want $80,000 a month. That is not going to happen, correct? Otherwise you will land up nowhere. You have to keep your expectations in terms of what is prevailing around market. And of course, when it comes to your pay expectation for your services, your skill also plays a big role. Maybe you are highly skilled. Even as a fresher, you can be a big value addition to the employer for whom you are going to work. But when it comes to investment does not have any skill role to play. As a result, what is prevailing as rate of return in the market becomes one point of your consideration. That becomes your expected rate of return, and that is your minimum expected rate of return. You are okay to earn more than that, but you will definitely not be okay earning anything less than that. Now, another point of origin of this discounting rate could be your cost of capital. See, when you are arranging funds in your business, you are incurring some cost of capital, correct? You can arrange funds, long-term funds particularly, you can arrange by debt, that is by borrowing or issuing bonds and debentures, or you may go for long-term issue of securities like a preference share. You may arrange money by issuing common stock, which is going to be perpetual. The point is, when you are arranging all these funds, keep in mind one thing: these funds are coming to you not free of cost. Everywhere cost of capital is getting involved. So cost of capital for you, suppose it is 12% a year, then can you invest that money in any investment project which is yielding less than 12%? You cannot do that, because in that case you will end up earning less than what you have incurred as cost. So your cost of capital is 12%, you must earn at least equal to 12%. Then comes the concept of opportunity cost of capital. So for example, if the prevailing rate of return in the market is 15% per annum, what will happen? I will be finding a lot of opportunities to invest at 15%. Then if you ask me to invest in certain project, I will have to forego this opportunity of investment at 15% and invest in the project that you are suggesting. In that case, my opportunity loss will be considered as my opportunity cost of capital, because if I have sacrificed 15%, I must get at least 15% from an alternative investment. As a result, the opportunity cost of capital also emerges. So all these factors you must consider as important factors in connection with the discounting rate. So let us write up some notes further. 2 points that you have already observed on screen: discounting rate represents expected rate of return. The expected rate of return is not any imaginary or fancy rate, it is completely realistic. It represents a minimum rate of return below which the investor will not agree for making any investment. It is also known as cutoff rate. When the company arranges funds from various long-term sources, it incurs cost of capital. The overall cost of capital becomes the minimum expected rate of return. That is why cost of capital itself represents the discounting rate. Let us move ahead and continue writing further. If a company arranges long-term funds at overall cost of capital of 12% per annum, then it will never make any investment where the rate of return is less than 12% per annum. Therefore, in such scenario, 12% per annum becomes the cutoff rate or the discounting rate. Let us assume that the rate of return prevailing in the market is 15% per annum. In such a situation, the company would obviously expect same rate of return from any project it is considering for investment. In this case, company will not accept any returns below this 15% cutoff rate. Let us move ahead and continue writing further. In the above case, if the company is offered a project that has internal rate of return of 14%, that is IRR of 14%, the company will obviously reject the project because its expected rate of return is 15% per annum. Now, in this class, I am not going to talk about what is internal rate of return. I would just give you a small point that this is the return generating capacity of any project. In the immediate next class, our focus point is going to be understanding what is internal rate of return and how to determine internal rate of return. We are also going to practice questions based on computation of net present value. So what I'll do is the calculative examples of net present value and internal rate of return, I'll be doing it almost together. But yes, let us keep the conceptual discussion little aside. But yes, you need to at least understand what is the fundamental meaning of internal rate of return. See, earlier sometime back I have been telling you that if the project's rate of return generating capacity is higher than what you expect, then you should invest into that project. Means what? Project's rate of return generating capacity itself is the IRR, that is internal rate of return. So in this example, what we find that your expected rate of return is 15% because you have investment opportunity available in the market which is offering you 15% return. If you are making investment anywhere, you are sacrificing that opportunity of 15% and making investment over there. In that other alternative investment project, your opportunity cost of capital being 15%, your minimum expected rate of return or your cutoff rate also becomes 15%. So if that project's IRR, means if that project's return generating capacity is only 14% per annum, obviously it will not be a feasible project for you and you will not accept that project. You will not prefer making investment in that project. You will reject that offer, you will reject that proposal. You are better off earning 15%. If you get a project which is offering you 16%, 18% returns higher than what you expect or higher than your required rate of return or cutoff rate, then you will happily make investment. So it is always comparison between what is your discounting rate and what is the internal rate of return. Once again, I am telling you, I am going to talk in detail about internal rate of return in the immediate next class. Let me first focus more on the connection between these two, that is the discounting rate and internal rate of return. And to bring forward important aspect with respect to discounting rate, which is originating from opportunity cost of capital. So look at this point. Investing in any project, the company has to sacrifice the opportunity of making investment at 15%. Therefore, 15% per annum is identified as opportunity cost of capital and hence it becomes the discounting rate. The company will accept an investment proposal when IRR of that investment is greater than the discounting rate because the company will earn more than expected.